So the Central Bank of Nigeria held the monetary policy rate steady at 27%, and the governor, Olayemi Cardoso, announced the decision after the Monetary Policy Committee's 303rd meeting in Abuja yesterday, saying all 12 members voted unanimously to maintain the current stance. Now, the committee also kept the standing facility corridor at plus 50 and over minus 450 basis points. And so it retained the cash reserve ratio at 45% for merchant banks and 75% for non-TSA public deposits, and left the liquidity ratio at 30%. Cardoso said that the decision reflects Nigeria's recent trend of low and stable inflation. So this morning, we continued that particular conversation as we bring in Faiz Mohammed, a development finance expert, and he will be sharing his thoughts with us. Faiz, thank you so much for joining us.
Good morning. Happy to be here.
You're welcome. Now, the MPC voted unanimously to hold the MPR at 27%. What is your view as regards this? Like, was it the strongest factor in terms of how you see behind the unanimous decision?
Yes, well, I think there was a desire on the part of the MPC to preserve the fragile stability that has only recently begun to take shape in the economy. When you look closely, you'll see that the committee wasn't just reacting to inflation numbers, they're also responding to the broader macro landscape, FX flows, global uncertainties, and the need to anchor expectations. The country has gone through an extended period of volatility, and the last several months have produced the first signs of calm, more predictable reserve movements, narrowing of inflation swings, and improved investor confidence. I think a rate cut would have risked reigniting speculative behavior and encouraging premature risk-taking, especially in the FX markets where confidence is still very delicate. So I think it was about credibility, signaling discipline, and giving previously implemented policies time to fully transmit through the economy. Really, in short, stability was the strongest factor, and I think that's what led to the unanimous decision.
Well, but we've seen a few, fluctuations in the forex market. Even the global tensions that we've seen has actually disrupted, the flow, of course, in the global markets. And all these are things that we probably might need to actually factor in, of course, looking at this particular decision. So how stable would you say these indicators are? Is it something that you are confident enough to probably put your money on?
Well, you see, the fact of the matter is inflation isn't just slowing, it's showing early signs of becoming more predictable. And I think that distinction is what policymakers care about. Over the last few months, month-on-month inflation has moved within a very narrow range. Food inflation has decelerated from its very high peaks, and core inflation, which reflects the underlying price dynamics, has softened far more clearly. And I think these are meaningful shifts because they show that inflation is no longer being driven by simultaneous shocks across multiple sectors. Whether or not these are solid enough, I would say that while they are encouraging, they're still fragile. I think this stability reflects monetary tightening and improved FX management. But these gains can easily be reversed by external shocks. I think the MPC stance is essentially, if the direction is right, then the foundation isn't wrong, at least not yet. The numbers are encouraging, but they're not declaring victory as of yet. And I think that's the correct posture.
Okay, so even with the inflation easing now, many Nigerians still feel price pressure. So how do you think the public should interpret the disconnect between data and daily experience?
So you see, the disconnect is rooted in how inflation is measured versus how households actually experience economic hardship. You see, inflation tracks the rate at which prices increase, but it doesn't actually track the cost of living itself. So when the data says inflation is slowing, it doesn't mean prices are falling. It means that they are rising more slowly. So for a family whose food basket doubled over the past year, a slight moderation is not going to feel like too much relief. I also think there's the issue of income stagnation. Salaries have not kept pace with the rapid rise in transport, rent, electricity costs. So even small price increases feel overwhelming because households are operating with extremely tight budgets. Nigerian families spend a disproportionate share of their income on very few essentials, especially food. And so those items tend to be the most volatile and the most sensitive to foreign exchange movements. I think the public should interpret the disconnect in that the economy is stabilizing at a technical level, but that the benefits are slow to reach the household, basically. So inflation is the first step, and restoring purchasing power is something that takes much longer. The data is real, but so is the hardship.
Okay, let's look at the banking industry. Now, the CBN maintained the standing facility corridor at plus 50 and minus 450 basis points. Now, what does leaving the corridor unchanged, but then looking at these particular figures, what would you say it signals as regards short-term liquidity management?
I think it's a very clear message, actually. Essentially, they're saying that they're comfortable with the current market behavior and they don't want to introduce new volatility into the system. The corridor acts as a guide. If it shapes how they borrow or lend to the CBN, which in turn influences overnight rates. If the CBN had narrowed or widened the corridor, banks would have immediately adjusted their liquidity strategies, and which would trigger unpredictable ripples in the interbank market. So I think by keeping it steady, the CBN is simply preserving stability in part of the financial system that is already highly sensitive to policy shifts.
So what about the cash reserve ratio held at 45% for merchant banks and 75% for non-TSC public deposits? Is the CBN prioritizing liquidity control over credit expansion, perhaps?
I think those are exceptionally high reserve requirements by global standards, and they effectively lock up a significant portion of the deposits banks could otherwise lend out. For the CBN, I think it's a deliberate trade-off. They're allowing too much liquidity into the system would reignite inflationary pressures or fuel speculative demand. So their approach is a little bit defensive, protect macroeconomic stability first, even if it means sacrificing some near-term lending momentum. I think the argument is that credit expansion without macro stability could possibly backfire. That would lead to higher inflation, weaker currency, and of course, harsher economic conditions generally. Liquidity is the priority, certainly, but I think the logic is to stabilize the foundation before allowing credit growth to resume at a sustainable pace.
Okay, Faiz, I'd like you to just stay with us for a while, all right? We need to quickly go on a break. When we return, we'll look at how this will spin into the festive season that is about dawning on us, right? So, Faiz, stay with us. When we go on a break and we return, we will continue with this conversation. As we understand that the CBN's MPC has reserved or retained, of course, the rates at 27%. We are looking at what attendant effect that would have on the overall markets. And we've been talking to Faiz Mohammed, who is the development finance expert, of course, and who he has been sharing his thoughts with us as regards this. So I'm just going to continue with the conversation even as we draw this to a close. So Faiz, now with the festive season, spending approaching, is the current policy stance strong enough to keep short-term price spikes in place?
Yes and no. The festive season traditionally brings higher demand for food, for household goods, for transport, which naturally puts upward pressure on prices. I think the current monetary stance and liquidity conditions are intentionally tight, and so it's strong enough to prevent an inflation surge driven by excess money supply. However, typically festive season price hikes are rarely driven by monetary factors alone. There are structural issues. There might be limited food storage, poor logistics in some areas, higher transport costs due to fuel demand. So these can also cause temporary spikes in prices, even when monetary conditions are tight.
Now, we see that borrowing costs for some businesses still set to be high. So does maintaining the MPR at 27% risk slowing investments, probably, for these businesses?
Like I mentioned earlier, it is definitely a trade-off. Keeping the MPR at this level does risk slowing down investment and job creation in the short term. But the MPC's argument is that the alternative, which is easing prematurely, could be far more damaging in the long run. If lower rates reignited inflation, businesses would face higher input costs and unpredictable price movements. Those conditions destroy jobs far faster than high interest rates do. So I think the balance is delicate, but stability remains that foundation for future growth.
And we see that banks, have actually had some sort of a strong balance sheets after recapitalization over the course of a few months. But then should that have encouraged maybe a more accommodative stance, or probably this cautionary measure by the MPC is actually apt? Because a couple of days before the MPC meeting, some financial analysts actually predicted that there would be some sort of interest rate cuts by 100 basis points, 200 basis points. But here we are in terms of the decision made yesterday. What do you think?
On the surface, stronger bank balance sheets could have created room for a more accommodative stance. But if the CBN eased simply because banks are healthier, it could have sent a very confusing policy signal. You see, markets interpret that as the CBN relaxing too early, which could once again trigger speculative behavior in the foreign exchange market. So the wiser approach would be to let recapitalization play out fully before adjusting the broader monetary stance. I think stronger banks are an important part of the economic recovery story, but they're not a substitute for overall macroeconomic stability. So I think the caution is necessary, even with improved balance sheets. The system is stronger, yes, but the economy as a whole is not strong enough to justify easing, at least not yet.
Okay, so we wrap up with this. I'd like to just understand better as regards the FX, market. So how does holding the rate support stability, especially with pressures around demand, reserves, and portfolio flows?
So holding the policy rates helps FX stability in several ways, actually. First, it keeps naira-denominated assets relatively attractive to both domestic and foreign portfolio investors. And then when rates are high and stable, investors are more inclined to hold Nigerian instruments, which increases FX inflows and supports those reserves. Secondly, a steady elevated rate discourages speculative borrowing, which could fuel demand for foreign exchange. If the CBN had cut rates, the immediate effect might have been a surge in naira liquidity, some of which would inevitably chase dollars in the foreign market. Third, maintaining the rate reinforces credibility on the part of the MPC. Foreign markets respond not just to data, but also to confidence. So investors are often looking for consistency in policy direction, and any abrupt shift can trigger uncertainty and capital outflows. A stable rate slows inflation, which in turn reduces the pressure on the currency. In essence, if you hold the rate stable, it's a broader strategy to support foreign exchange markets by keeping expectations anchored and preventing liquidity-driven pressure on the naira.
Well, of course, we know that growth expectations are actually moderate right now, but as you said, confidence is quite fragile. So we're probably just going to continue to monitor to see how the market will react to this particular retainment by the MPC before the next meeting. But then thank you so much, Faiz Mohammed, development finance expert, for sharing your thoughts with us on the show.
Thank you for having me.
Of course, you're welcome. So we turn our attention to IDAN Young Scholars Workshop. Of course, there was a day one conversation with discussions centered on the structural and institutional barriers shaping Africa's economic trajectory, from systems that entrench dependence to tax regimes that actually strain citizens while delivering limited growth. So within these contexts, there emerged some sort of a critical framing in the discussion that has to do with what we should imagine in terms of macroeconomic policies and how that would actually affect the entire ecosystem. So what does it mean? Now, Professor Milton Friedman suggested that what we describe as monetary policy is in fact credit policy rather than true money supply management. So we will be taking this particular video excerpt where Joanna Mustafa, New Central's business correspondent, engaged Reg Nkosi, executive director of First Source Money, looking at this particular discussion at the Iden Young Scholars event.